Hello everyone. When people begin learning about investing, they often hear about something called an index fund. It's frequently recommended by financial professionals and experienced investors, yet many beginners aren't quite sure what an index fund actually is or why it's so popular. Some assume index funds are complicated financial products. Others believe they're only for advanced investors. In reality, index funds are designed to be simple, efficient, and accessible. In this video, we're going to clearly explain what an index fund is, how it works, why investors use it, and what role it plays in building long-term wealth. By the end of this video, you'll understand why index funds have become one of the most widely used investment tools in the world. So what is an index fund? An index fund is a type of investment fund that is designed to track the performance of a specific group of investments, known as an index. An index represents a portion of the market, such as a group of large companies, a certain industry, or the overall market. Instead of trying to pick individual winners, an index fund aims to match the performance of the index it follows. So why were index funds created? Index funds were created to provide investors with a simple way to invest in broad portions of the market. Rather than researching and selecting individual investments, investors could gain exposure to many companies at once. The goal was to offer diversification, lower costs, and consistent market returns. Index funds made investing easier and more accessible. So how does an index fund work? An index fund holds the same investments that make up the index it tracks. If the index includes hundreds of companies, the index fund owns shares of each of those companies in similar proportions. When the index rises or falls, the value of the index fund moves in the same direction. This allows investors to participate in market performance without selecting individual investments. So how is an index fund different from actively managed funds? Actively managed funds rely on professional managers to choose investments in an attempt to outperform the market. Index funds follow a set index automatically and do not attempt to beat it. Because index funds require less management, they typically have lower fees. Over time, lower costs can significantly impact overall returns. So why do investors prefer index funds? Many investors prefer index funds because they offer broad diversification, lower costs, simplicity, and consistent market exposure. Index funds reduce the need for constant decision-making and market timing. They also allow investors to focus on long-term growth. So how do index funds reduce risk? Index funds spread investments across many companies and industries. This diversification reduces the impact of any single company performing poorly. While index funds still experience market ups and downs, they tend to be less volatile than owning a small number of individual investments. So, can index funds lose value? Yes, index funds can lose value, especially during broad market downturns. Because they follow the market, they rise and fall with overall conditions. However, over long periods, markets have historically grown, which is why many long-term investors use index funds as core holdings. So what types of index funds exist? Index funds can track many different parts of the market, including broad stock market indexes, large company indexes, small company indexes, international markets, and bond indexes. This variety allows investors to build diversified portfolios using multiple index funds. So how do index funds generate returns? Index funds generate returns through price appreciation as markets grow, and through dividends or interest from underlying investments. These returns are passed along to investors based on their share of the fund. So why are costs important with index funds? All investment funds charge fees, known as expense ratios. Index funds typically have much lower fees than actively managed funds. Lower fees mean more of the investment return stays with the investor. Over time, small fee differences can lead to large differences in wealth. So how does someone invest in an index fund? Imagine someone named Alex wants to start investing for long-term growth. First, Alex opens an investment account with a brokerage company. This could be a retirement account or a regular investment account. Next, Alex researches index funds and chooses one that tracks a broad market index. After reviewing the fund's information, including its fees and performance history, Alex decides to invest. Alex deposits $1,000 into the account and uses that money to buy shares of the chosen index fund. From that point on, Alex owns a small piece of all the companies within that index. As the market grows, the value of Alex's investment grows too. Alex can also add more money regularly, such as investing $100 each month, steadily increasing the investment over time. This simple approach allows Alex to build wealth gradually without picking individual stocks. So how do index funds fit into long-term investing? Index funds are commonly used as long-term investments. They allow investors to participate in overall market growth while maintaining diversification. Because they don't rely on short-term decisions, index funds support consistent, long-term strategies. So are index funds good for beginner investors? Index funds are often recommended for beginners because they are simple and diversified. They reduce the pressure of choosing individual investments and help manage risk. Many investors start their investing journey with index funds. So how do investors choose an index fund? Investors typically consider the index being tracked, costs and fees, fund size and stability, and investment goals. Choosing an index fund that matches objectives is more important than trying to predict short-term performance. So how often do index funds change their holdings? Index funds adjust their holdings when the index itself changes. This may happen when companies enter or leave the index. The process is usually automatic and requires little investor involvement. So, can index funds be used for income investing? Some index funds focus on investments that generate income, such as dividend-paying stocks or bonds. These funds can provide regular payments while still offering diversification. This makes index funds useful for both growth and income strategies. So how do index funds compare to individual stocks? Index funds offer broader exposure and lower risk than owning a few individual stocks. Individual stocks can provide higher potential gains but also greater risk. Index funds prioritize consistency and diversification over concentrated bets. So why have index funds become so popular? Index funds have grown in popularity because of their simplicity, low costs, and strong long-term performance. They align well with long-term investing principles and disciplined strategies. Many professionals and everyday investors use them as core portfolio components. So how should beginner investors think about index funds? Beginner investors should view index funds as building blocks. They provide easy access to markets, diversification, and long-term growth potential. Rather than trying to predict winners, index funds allow investors to grow alongside the market. An index fund is a simple and efficient way to invest in a broad portion of the market. By tracking a specific index, these funds provide diversification, low costs, and consistent exposure to market growth. Index funds have become a foundation of long-term investing because they help investors manage risk while building wealth over time. Understanding how index funds work gives you another powerful tool for creating a strong and balanced investment strategy. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.